Welcome to a new episode of Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. Like I always say, this is the podcast that will make you a smarter investor, period. Let's put up 1 minute on the clock, our shot clock, stock of the day, going Best Buy on this news that President Trump or the Trump administration will exempt smartphones, computers, and certain electronics from those China tariffs. And there was just this massive relief. Suddenly, companies like Apple are going to do amazingly in terms of financials. But when you dig beneath the results, the 20% tariff is still in place here. So I want to lock in on Best Buy, because when I originally heard this news, I'm like, all right, Best Buy's year's going to be saved. This is great. Rah, rah, Best Buy. No, that's not the case. And here are some numbers here from the folks at Citi. So the 20% China tariff is still in play. So that means a lot of products that Best Buy sells, smartphones, electronics, computers, will still be hit by that tariff. Citi estimating Best Buy could see a 15% product cost inflation hit, almost 1,000 basis point hit to gross profit margins this year because of that 20% tariff, assuming there's no mitigating factors. To me, that spells not a good financial holiday season for a company like Best Buy. And I'm out of time. That's all I got on Best Buy. All right, let's continue to drill into markets here. Special guest, Larry McDonald, author, the Bear Traps Report founder. Good to see you in person. I know you're really traveling the world, so good to see you in Times Square at the NASDAQ.
Yeah, it's been a good run. I mean, our book came out, and the main thesis of the book, How to Listen When Markets Speak.
Great book. Great book.
This multipolar world that drives a colossal migration of capital, and that's what kind of played out last week.
You were the bond guy, and holy cow, we have seen some major moves in the bond market. The 10-year up to 4.5%. I thought when stocks sold off, you go into treasuries, but that's not working. Why?
Okay, for the last 40 years, you're right. Whenever we go risk off, so down in stocks, bonds have gone up. And it has a lot to do with the flight to quality, United States of America, and trust. And there's two elements of trust that have been broken. Congress broke the back of the trust around the debt. So 37 trillion of debt, but that's up 11 trillion in the last 4 years, right? So global investors were already a little sick to their stomach with the United States and that amount of debt. But then Trump came along with a sledgehammer and said, we're going to change the world order on trade, right? So if you're a European investor for the last 30 years, you've just loved the United States most of the time. Now, when I spoke last week to European investors, they're losing money on their stocks, they're losing money on their bonds, and the foreign exchange. So if you own U.S. stocks in any kind of euro or any kind of currency in Europe, you're losing money on the currency as well.
So they're not happy clients.
No, and so what that's doing is imagine a whitewater river of incoming cash coming into the United States, just violently reversing and going the other way. That's what's happening.
What's the signal that the bond market is sending you?
It's just signaling a lack of trust in the sense that that world order that we've had is changing, first of all. And what we make the point in the book, How to Listen When Markets Speak, is this great migration of capital. If there's that much uncertainty in bonds, which for the bedrock, then we should see capital move from financial assets, which are financial assets. All that means is paper certificates, bonds and stocks. That's paper. We should move over toward hard assets, which we've kind of see over the last year. Silver's outperforming the NASDAQ. Gold's outperforming the NASDAQ by 30%.
And that's not the norm here. Yeah. I mean, investors have been trained the past 10 years. Stocks like NVIDIA and Apple go up in a straight line, and maybe own 2% of your portfolio in gold, or maybe 1%.
Newmont Mining, up $15 last week. And this is a stock that Buffett bought years ago, Buffett's team. So it's not like that's not the only place to be, but companies that own assets in the ground, whether it be natural gas, whether it be platinum, palladium. I mean, there's so many metals that are strategic for just this whole AI revolution. I mean, I think we're going to have a copper crisis in 2026, 27, where the amount of copper needed for the Ukraine rebuild, right, for the Gaza rebuild, for artificial intelligence, for robotics. Supposedly all these robots are going to replace human beings.
And they all need metal.
They all need copper and strategic metals, and that's where the real money's going to be made. The old portfolio was your 60-40 stock bonds, belong a lot of growth stocks. That was like the 2010 to 2020 portfolio. That's history. The new portfolio that we line up in the book is a portfolio of kind of hard asset companies.
Is the bond market suggesting that the bond market losing trust in the U.S. credit worthiness, and how big a deal is that?
It's enormous. Now, it can be won back through deficit reduction and through taxation. And people forget, all tariffs is taxes on global. So a tariff is just a tax on global investors.
I just got hit with 145% tax.
Yeah. Now Americans do pay it. If you want to buy an iPhone, you're going to pay a higher tax, right? But the thing about tariffs is global companies and global countries are also sharing that tax. So to get out of this debt hole, we can raise taxes on global companies, global investors, U.S. citizens, or we can default. I mean, interest on the debt is $1 trillion a year, right? That's 25% of tax receipts, 20% of tax receipts, and the rest of the developed world is only the rest of the developed world in terms of interest, annual interest cost versus their tax receipts. The rest of the developed world's like in the 2, 3, 4 to 6% group.
I caught a post from you on X. I don't know where you were, but you were breaking down the stress we're seeing in the bond market, and you dropped Lehman. And you lived and managed. That's the first time I came in contact with your work during the great financial crisis. Are we headed towards Are we headed towards a crisis in the bond market?
Yes, they're going to put some fire hoses into this, right? But in terms of the bond market's real sustainability as a safe haven, those days are starting to just slowly go away. And that means that you're going to own different types of bonds. You're going to own bonds of other countries, not just it's just everybody was overdosing on the U.S., right? And all it means is that your global investors are going to have a more diversified portfolio. They've been burnt by this lack of trust. It's like there's certain things that we've all been through these horrible experiences when you can't unsee something, right? The global investors have just been hit over the head with this huge amount of debt that the United States has, this kind of lack of trust in spending in Congress, and then Trump with the sledgehammer on tariffs trying to raise taxes. And they're just like, okay, I'm going to have a basket of bonds, and that's what's breaking down the bond market. They're just going to try to own other things besides just being overdosed on growth stocks and U.S. Treasuries.
Bray, let me see if I can make this through line. So China, the second largest holder of treasuries, and they're getting hit with these large tariffs from the Trump administration. Do you envision them dumping treasuries? If so, do they do so aggressively? And what are the ramifications of China doing that to the U.S. economy?
See, that's part of the scare out there, is that China doesn't even have to dump, but if they leak that they might dump, then other people try to get in front of that. There's also a lot of banks that are in this whole basis trade. That's a big problem. That's unwinding. A lot of hedge funds, really, that are in this trade, and that's unwinding. So it's like a combination of China and people worrying about China and Japan. You know what? We're in a trade war with them. Maybe they're not going to be there to buy our bonds. And so there's that worry. And then we have this very complicated basis trade that's blowing up. And so those things are happening at the exact same time. So at the end of the day, what I talked about on my video is the last 30 years, whenever there was a crash in the stock market, when Lehman went down, you made $8 trillion. They lost $8 trillion of stock value, but they made $3.5 trillion back on bonds. And when COVID hit, investors lost $9 trillion, but they made $4 trillion back on their bonds. Imagine that. Now, we've lost $9 trillion since February 19th, $9 trillion, and you basically haven't made anything back on the bond side.
If you were sitting with the Treasury Secretary instead of Brian Sozzi this morning, what would you want to know from him?
Well, first, I would want to have someone like a Scott Bessent that's running the show instead of like Navarro one day, Lutnick the other day.
These hawks, these real policy hawks.
And they're really they mean well, but they are crushing global sentiment on the world order. They're basically what we talk about in the book. We're in a multipolar world versus a unipolar world. A unipolar world with the United States is like the strong empire, and its kind of leadership and globalization is very stable. A multipolar world is something like where we have Navarro and Lutnick out there really threatening our allies and our trading partners. And that kind of hostility is driving money out of the United States. So if I was Besant, I'd want to have him, I'd want to be taking that wheel away from Navarro and Lutnick.
Yeah, especially, they really say some shocking things. Hang with us, Larry. We're going to go off for a quick break. We're going to be right back on Opening Bid, talking more on bonds, stock market, and of course, the economic outlook. We'll be right back. All right, welcome back to Opening Bid here. Having a great chat here with Larry McDonald, the Bear Traps Report founder, also author of How to Listen When Markets Speak. Encourage everyone to give this one a read. Really, really good book. So we were talking about the Treasury Secretary, Scott Bessent. I feel like his focus on tariffs is distracting him from some of the bigger things he wants to do, cut the deficit. Is that just not going to get done in this administration?
Okay, so let's go really quick. When Lehman failed, right, the fiscal and monetary response, was $4 trillion. When COVID went down in 2020, and then you had the regional bank crisis after that, and then the elections, where fiscal spending in Washington was crazy into the election, that response was not $4 trillion, it was $16 trillion. So think of Lehman, 4 versus 16. Now Bessent is Treasury Secretary. He's got to sell bonds to the world to finance this huge buildup. Chief bond salesman, exactly. And it's harder to sell bonds. And unfortunately, what they've tried to do is Yellen, in the last year and a half, 2 years.
Former Treasury Secretary.
Yeah, former Treasury. She issued tons and tons of T-bills. So imagine like borrowing money for like 6 months, 1 year. And she brilliantly placed bond volatility not in the election year. She actually, by doing all, because T-bills mature in 3 months, right? 6 months. So those bonds can't move in price, right? So she pushed all that bond issuance out into 2025, 26. So she placed bond volatility brilliantly in the hands of the Republicans.
So what happens though? What's the response? What's going to happen to the bond market later this year?
He has to go sell these bonds and to a more, with Navarro and Lutnick trying to he's in the worst possible spot. And so he's going to try to calm things down. And at the end of the day, they're trying to repair 40 years of dysfunction in Washington in a very, very short period of time, in 4 years, and they're trying to take as much pain away from they want to take the pain as far away from the midterms as possible, right?
You have a real global view. I mean, you're constantly on the road and traveling. How do your international clients view what is happening in the U.S., but then by extension, how they view what's happening to them?
So we run a Bloomberg chat and a private Discord room with institutional investors in 30 countries. The Bear Traps Report is the company, but most of our revenue is from at least 50% is from hedge funds, mutual funds, and pension funds around the world. And the trust that's been broken the last, imagine you're a bond investor and you just watch the U.S. jack up the deficit, borrow a lot of money in the front part of the curve, which makes us look a little bit like an emerging market country, and then come out with a way to fund it through pounding taxation around the world to other countries. It just creates this lack of trust. I talked to a guy in Zurich yesterday, and he's runs billions of dollars, and he's like, Larry, all we had to do the last 30 years is just sit back and really over-allocate to the United States. So you imagine all these allocators, that's all they've done is over-allocate into U.S. stocks and bonds. And so they're up to here in terms of allocation. And now they just have to take it down back to where we were maybe 10 years ago, but that's at least $1 trillion.
What are they waiting for to put money back into the U.S. stock market? What do they need to see? And do they have trust anything that they want to see might actually happen with this administration?
Like he said to me, there's certain things you can't unsee. And with these trends around currencies and bonds and stocks, especially currencies and bonds, when those trends go this way, they would need to see Congress take total control over taxation away from the White House and have that guaranteed for at least a year. And so the White House means well. They're trying to undo 40 years of dysfunction where we've lost 5 million jobs. Let's not kid ourselves. The reason why Trump was elected twice, pretty much, is the manufacturing base of the United States has been absolutely hollowed out. And he's trying to fix that. But the way they're going about it and the rate of change that they're trying to go about it is very fast and very shocking. And so to your point is where's the fire hose that's going to put this out? I guess if Congress were to take taxation and tariff authority away from the White House and stabilize it and give the global investment community a 1 or 2 year certainty of where we would be on tariffs, that would go a long way, but that's just not going to happen for me.
You mentioned manufacturing, and a lot of CEOs that I talk to, they tell me a couple of things. First, I can't build a plant overnight.
Right.
And then two, if I do build that plant, it opens 5 years from now, it's going to cost me more to make stuff in the US. And then I look back at things that Apple CEO Tim Cook has said. He says in 2015, I think he did an interview on CBS calling out a lack of skills in the US to do this. Do we want a $3,500 iPhone? Is that what we're looking for here?
That's the problem. It's when you decimate the United States working class for 30, 40 years, Republicans, Democrats, trying to fix that, it's going to take a long time. And Trump, they want to sell us that they can fix this. But yeah, if you're Apple or any company that makes, one thing that makes the most sense is just giving golden visas to the most talented technicians in semiconductors, because that's the one area where I think the Trump team is 100% right. National security, artificial intelligence, right?
You can't have all these chips made by Taiwan Semiconductor.
It's absolute insanity. It's literally a recipe for a massive shock. I mean, bigger than Lehman, right? If Taiwan were to be invaded. So what we should be doing is giving golden visas immediate access for, thousands of the best technicians in the semiconductor space, get them over to the United States. But like you said, cost of living here is higher. That's all part of our book. What we talk about is when you reshore, you're just going to raise the cost of everything, and we're going to go into a higher interest rate, higher bond yield, higher inflation regime that's going to last. Very similar. We went from like 1968 to 81 after the Vietnam War.
Yeah.
And all of a sudden, if you're in that higher interest rate, higher inflation regime because of reshoring and because of wars and global conflicts, then you need a whole new portfolio construction. And that's why reach out to us at the Bear Trap Support, because that's what we're all about. It's like, okay, we're going to look, what is the portfolio for the next 10 years, not the last 10 years. And I think if you look at American investors, there's still like table max, the 2010, 2020 portfolio.
Maybe you see it, but I'm listening to everything you're saying. I stack it up against the things that I see and hear. I don't see the catalyst to get into markets here. I'm not picking stocks. That's not what I do. Where's the appetite to jump in here and buy NVIDIA off its highs? Okay,
so within the last week, NVIDIA, both Exxon and Chevron were combined. Exxon and Chevron were only 29% of NVIDIA's market cap. The entire copper industry, like your Freeports and all these, just look at the COPX ETF. If you add up the value of all those companies, it's a fraction of NVIDIA. But if you really, really, really listen to Jensen and the NVIDIA gods, the only way they get to their growth trajectory that's needed to justify that close to a $3 trillion valuation, the only way you get there is with a lot more copper. So if you look at the copper names or the oil names, they're down 30, sometimes 25, 30% off the highs. And the future looks great for them because the valuation setup is so skewed. Just NVIDIA is up here and the entire copper industry is here. NVIDIA is here, the entire uranium industry for all the nuclear power they're going to need to finance to power all these new AI data centers, right? Sure. So it's so skewed. So you can make a lot of money by investing in the power infrastructure plays. Your SMRs, there's a lot of ETFs that are in this space, URNM, right? Where you're investing in a basket of companies that are going to power AI for the next 30 years.
I want to get your hot take. It's what we do towards the end of the podcast. You mentioned the portfolio for the next 10 years. What is that portfolio? Because I imagine the next 2 to 10 years are going to look a lot different because of these tariffs and how unsettling things have been.
Okay, so let's go back to basics. Last 30 years it was 60-40 stocks bonds, and out of that 60 there was a lot of growth stocks in there, right? Your FANGs and just big growth stocks. We're probably moving to a 30-30-40 world. So 30% commodities, 30% bonds. It depends on the age of the investor, and say 40% stocks. In that world, you want to have less growth and more value. That's why the I think it's COWZ ETF, those types of stocks are outperforming. Global value, the EWU ETF. Just look at the holdings of the EWU. It's a group of global companies, your Glencores, your BHPs, you're more like your Rios, your Rio Tintos. And so your companies that own assets in the ground, your companies that own lots of copper reserves, right? FCXs of the world. You want to look at the COPX. That's the portfolio. So you're going from 60-40 stocks bonds to 30-30-40, and out of that stock portion, you should have more value and more companies that own hard assets like the COPX, like the GDX, like the SIL, like the URNM. These are all ETFs that own baskets of companies that are in the AI infrastructure space, that are also in the robotics space in terms of supporting the robotics industry through copper, and then the United States rebuild of Los Angeles, the rebuild of the Ukraine, the rebuild of our power grid in the United States. That's all copper, right? How much copper are we going to need to rebuild Los Angeles, the Ukraine, and the U.S. grid to support all that artificial intelligence? It's a ton of copper, and so you want to be long those copper names, and that's where you're going to get far better portfolio construction and returns by owning the copper names than owning NVIDIA looking forward.
Great insights as always. That's why we always have you on here. Larry McDonald, the Bear Traps Report founder, and of course the author of How to Listen When Markets Speak. Give this book a read. Really good stuff. Larry puts all his passion that you see on camera here right into this book. Good to see you.
Thanks, Brian.
All right, good to see you, man.
Good to see you.
All right, and that's it for the latest episode of Opening Bid. Continue to hit us with all those stars on all the podcast platforms and thumbs up on YouTube. Love your feedback. Always try to answer your questions. Keep it coming. We'll talk to you soon.